Inside banks, clearinghouses, and regulatory institutions, the mechanics of the financial system continue to operate exactly as described in policy manuals and supervisory guidance. Liquidity reports still circulate through Treasury desks. Capital ratios are still calculated using established regulatory formulas. Collateral schedules still update across clearing systems. Nothing in these processes appears unusual. Yet within those same procedures, buffers are appearing inside operational planning models more frequently than before. The definitions themselves have not changed. Liquidity buffers remain disclosed in quarterly filings. Capital buffers remain embedded within regulatory frameworks. Collateral buffers remain defined within clearinghouse margin systems. The ratios are still printed in disclosures. The thresholds are still written into regulation. The policy language remains intact. But the way institutions interact with buffer space inside those frameworks has shifted quietly. Originally, buffers existed as protective margins, capacity that institutions hoped never to rely upon except during unusual conditions. Their presence signaled preparedness, not expectation. Crossing into buffer space once carried interpretive weight. A liquidity buffer draw might trigger internal review. A capital buffer approach might prompt management discussion. A collateral buffer adjustment might attract supervisory attention. The framework itself remains unchanged. The ratios are still printed in disclosures. The thresholds are still written into regulation. The policy language remains intact. Yet in practice, buffers are now appearing inside operational planning models more frequently than before. They remain defined as contingency space, but the system increasingly treats them as usable space. And when contingency space begins to appear inside routine planning assumptions, the meaning of the buffer changes, even while its definition remains the same. Within financial institutions, buffers exist because the designers of regulatory and operational frameworks assume that conditions will not remain perfectly stable. Liquidity buffers appear within banking regulation as reserves of high-quality assets that can be used if funding markets tighten temporarily. Capital buffers sit above minimum capital requirements, allowing institutions to absorb fluctuations in asset values without breaching regulatory thresholds. Collateral buffers appear inside clearing systems and margin frameworks, ensuring that settlement obligations can continue even when market prices move unexpectedly. Each of these buffers performs the same structural function. They create space between ordinary operating conditions and formal limits. A liquidity ratio may be defined at a specific percentage. A capital requirement may sit above a regulatory minimum. A margin calculation may include a conservative multiplier. The buffer occupies the space between routine operation and constraint. Importantly, that space was never intended to function as part of everyday activity. Buffers were designed to absorb temporary disturbance. If conditions tightened briefly, an institution could draw slightly on its liquidity reserve. If asset valuations fluctuated, a capital buffer could absorb the variation without forcing immediate balance sheet adjustments. If volatility rose in derivatives markets, collateral buffers ensured that clearing systems continued to process settlements without interruption. In this sense, buffers were protective margins. Their presence indicated resilience. Their use, however, carried meaning. Crossing into buffer space suggested that conditions had moved away from the environment the framework considered ordinary, not a failure of the system, but a signal that variability had reached the edge of routine expectations. When buffers are approached for the first time, the response inside institutions tends to follow established escalation paths. Treasury teams review funding conditions, risk committees examine exposure reports, compliance units confirm that usage remains within regulatory allowances. Supervisory communication may occur to ensure that deviations are properly documented. The system does not stop functioning when buffers are used, but their use typically concentrates attention. Documentation expands, and internal commentary circulates through management channels. Usage is framed as a temporary adjustment within otherwise stable conditions. Over time, however, repeated interaction with the same space inside the framework changes the way it is interpreted. If liquidity conditions remain slightly tighter than the assumptions used when the framework was designed, Treasury desks begin incorporating modest buffer usage into routine funding plans. If asset prices fluctuate within a narrower but persistent range, capital planning models begin accounting for small variations within buffer capacity. If margin systems repeatedly encounter the same volatility environment, collateral forecasts begin to assume slightly elevated requirements within permitted parameters. Nothing in the rulebook changes. Definitions remain intact. Regulatory formulas continue to apply. Disclosure language remains exactly as written. What changes is familiarity. Participants interact with buffer space more often. The first encounter triggers review. The second becomes easier to process. By the third or fourth instance, the handling path becomes procedural. Buffers remain labeled as contingency capacity, but within operational planning, their presence begins to influence how activity is structured from the outset. As interaction with buffer space becomes more familiar, the way institutions structure their internal models begins to adjust. Liquidity planning provides one example. Funding desks typically project cash inflows and outflows across different time horizons. These projections incorporate deposit behavior, market funding costs, and expected settlement obligations. Historically, liquidity buffers appeared in those models as emergency capacity. They were resources that could be accessed if projections proved temporarily inaccurate. Over time, however, funding environments sometimes remain within narrower corridors than those originally assumed by the framework designers. When that occurs, Treasury desks begin incorporating limited buffer usage directly into forward planning. The buffer remains defined as contingent capacity, but funding schedules may assume that a small portion of it will be available if short-term conditions fluctuate within predictable ranges. Capital planning exhibits a similar adjustment. Capital buffers sit above minimum regulatory ratios so that balance sheets can absorb valuation changes without breaching formal thresholds. When valuation volatility remains modest but persistent, internal capital. Forecasts may include small variations inside buffer space while still maintaining compliance with regulatory requirements. Collateral systems display the same pattern. Clearing institutions continue calculating margin requirements using established risk models. Yet when volatility settles into sustained ranges, collateral projections may begin incorporating slightly elevated margin expectations as part of normal planning assumptions. None of these adjustments alter the structure of the framework. The formulas remain unchanged, the ratios remain published, the buffers remain labeled as protective capacity, but operational models begin to treat that capacity as space that may be used, within limits, as part of routine system activity. When buffers begin to appear more frequently inside operational planning models, the adjustment does not occur within a single institution alone. Banks continue managing funding, capital, and balance sheet exposures within regulatory frameworks. Clearinghouses continue calibrating margin requirements through established volatility models. Central banks maintain standing facilities designed to support short-term funding conditions. Supervisory agencies continue monitoring compliance through scheduled reporting cycles. Each domain operates under its own mandate. Each applies its own procedures. Yet the conditions those procedures respond to often originate in the same environment: funding spreads, collateral valuations, market volatility, and balance sheet constraints. When those conditions persist within certain ranges, similar adjustments appear across different parts of the system. A Treasury department may incorporate limited buffer usage into its liquidity planning models. A clearing institution may retain slightly elevated margin calibrations inside its risk framework. A regulator may observe institutions operating closer to buffer thresholds while remaining within compliance parameters. None of these actions require coordination. Each decision remains contained within existing authority. No new rule is introduced, no statute is rewritten, no supervisory mandate changes. What emerges instead is parallel handling. Different institutions, operating independently, adapt their procedures in similar ways because they respond to the same underlying conditions. From the outside, the frameworks remain exactly as they were written. Liquidity ratios are still calculated, capital buffers are still disclosed, margin systems still process collateral requirements. The system continues to function through the same mechanisms. Only the way buffer space is used inside those mechanisms gradually becomes more familiar. As buffer usage becomes more familiar within institutional planning models, behavior inside organizations begins to adjust in subtle ways. Treasury teams incorporate discretionary capacity into funding projections. Risk dashboards begin tracking buffer proximity alongside other operational indicators. Committees reviewing liquidity, capital, and collateral exposures allocate agenda time for buffer-related updates as part of routine oversight. None of these adjustments require formal policy changes. Internal procedures remain anchored to the same regulatory definitions and supervisory expectations. Liquidity coverage ratios continue to be calculated using established formulas. Capital requirements remain reported according to regulatory standards. Collateral frameworks continue operating through the same margin methodologies. The framework itself does not move. What evolves is how participants interact with the space the framework already provides. When buffer usage occurs occasionally, each instance tends to attract discussion. When it occurs repeatedly within defined parameters, the discussion becomes procedural. Tracking replaces interpretation. Updates replace escalation. Risk systems record the movement of ratios within acceptable ranges. Supervisory reporting reflects those movements through regular disclosure cycles. Operational decisions adjust incrementally in response to the same metrics. Participants do not treat the environment as unstable. They treat it as manageable. Planning models begin assuming that limited interaction with buffer space may occur during ordinary operations. Liquidity strategies incorporate flexibility within regulatory allowances. Capital planning accounts for valuation variability inside defined tolerance bands. The buffer still exists as contingency capacity. But inside daily institutional activity, its presence increasingly functions as part of the operational landscape rather than as an exceptional boundary. Within financial frameworks, buffers were never designed to replace the rules that surround them. Liquidity requirements remain defined in regulatory guidance. Capital ratios continue to appear in quarterly disclosures. Margin models still calculate collateral requirements using established volatility inputs. The framework has not been rewritten. The same limits remain printed in documentation, the same ratios remain cited in supervisory reporting, the same thresholds remain embedded in policy manuals and regulatory filings. Buffers still exist inside those structures exactly as they were originally described. What changes over time is how frequently institutions interact with the space those buffers create. When that interaction occurs occasionally, the buffer retains its original meaning as contingency capacity. When it occurs repeatedly within the limits already defined by the framework, the interpretation shifts quietly. The buffer continues to function as protection against instability, but operational activity begins to account for its presence more directly. Funding plans assume modest flexibility within liquidity margins. Capital projections include room for valuation movement within buffer space. Collateral planning reflects margin levels that remain elevated but manageable within the same framework. Nothing in the structure disappears. The rules remain visible. The ratios remain defined. The thresholds remain in place. The difference is procedural rather than structural. Contingency capacity becomes incorporated into planning assumptions. The buffer does not become the rule, but the system increasingly treats the space around the rule as part of how activity continues. Procedures still run, reports still circulate, ratios are still calculated, the framework appears unchanged. Activity simply moves through a slightly wider portion of it.